Well, let's dive right in. Let's go to this first article here that is titled, Survey Suggests Cap Rates May Have Peaked as Treasury Yields Stabilize. So right off the bat, what are cap rates? How do they affect buildings? I mean, what does this even mean?
Yeah, these are terms that are used a lot, and it's always important to kind of go back to the first principles and really understand what cap rates are. So cap rate illustrates the amount of operating cash flow a property is generated over the value of the property. So that it's a fraction, and that's where the cap rate comes from.
Okay.
And cap rates have an inverse effect over the compared to the value of the building. So it's kind of similar to bonds. You know, when the bond market, when yields go down, the value of those bonds go up. Mm-hmm. Similar to cap rates. So as cap rates go down, the value of the assets are increasing. When we look at cap rates, it's an important quick metric to say, okay, that's an 8 cap building. Oh, that's a 5 cap building. What it would imply is that the 5 cap building is a higher value compared to the operating cash flow that's being generated from the property.
Okay.
Compared to the 8 cap is a lower value compared to that cash flow. So broadly, when you go to some of these strongest markets for multifamily, New York, LA, and Dallas, and Phoenix is becoming one of those as well. One of the kind of top tier markets. You're typically going to be at a lower cap rate than if you were to invest in Tulsa, Oklahoma, or some other city in the Midwest where there isn't quite as much growth. Maybe those are more like an 8 cap.
Gotcha.
And it also means that the cash flow from the 8 cap is going to be greater than the cash flow from the 5 cap. But the long-term appreciation is probably going to be less. That's why you get a lower cap rate in those markets. So it's important if you're an apartment owner to understand where cap rates are headed and to keep that metric in mind as you kind of manage your portfolio. And so with this article, we don't know where cap rates are going. Mm-hmm. That's kind of the big question about investing, is where is the value of this heading? But this survey from Globe Street that they're publishing, and it's a survey from CBRE, suggests that cap rates have potentially peaked.
Gotcha.
Meaning the value of buildings have kind of bottomed, and that they're prepared to improve from here going forward.
Gotcha. Okay, it's interesting because, it's kind of like the opposite where you thinking the higher number, but it's lower. And
it takes a bit of time to get your head around it.
Right.
When I was studying finance in college and understood that the bond market has an inverse impact, bond yields had an inverse impact to the value of the yields. I was like, why is that?
This is so hard to visualize in your mind.
Because normally if let's say you're a bank and you're getting a higher percent of interest, that's good. So usually a higher rate means it's better.
Right.
But without getting into the weeds of it, you can just remember a lower cap rate means that the value of that building is higher as it relates to the cash flow of that building.
So you've mentioned like a rate of like an 8 or a 5. Do you ever see cap rates of like a 4, a 3, a 2?
Yeah, so we saw really low cap rates when interest rates were low in 2021, 2022.
Yeah.
So cap rates are really correlated and impacted by where the 10-year Treasury is.
Gotcha.
And that's because when you buy a piece of real estate, you're going to put debt on it. And typically that's 50 to 60% of the purchase is going to come from debt.
Okay.
So if your interest rate is lower, you can purchase the building for a higher price. And so that, as we look forward, interest rates are going to be the biggest driver of what happens with cap rates. And part of what this survey is also suggesting is that most property owners and people in our industry are expecting that we're starting a cycle of lower interest rates. It's one thing if the Fed lowers interest rates a little bit here and there, and that's what they've done over the past year and a half. From our peaks.
It's just incrementally lowered,
not a cycle.
lot.
Yeah, because there's been many opportunities, several times where the Fed met and they haven't lowered interest rates. In fact, their most recent meeting, they haven't. But people in the industry and people who follow this closely, and I'm kind of one of those geeks. I love to know what the Fed is thinking, what they're looking at. We're expecting that it's very likely we're going to get in a cycle of lower interest rates. Means they're going to lower interest rates consistently for a period of time, and that gets people excited because we've been in a cycle of not too long ago, 2 years ago, where they were increasing interest rates in that cycle every time they met by dramatic moves.
Yeah.
So it's one of the things that we look for, and we talk about this when you're an investor. You're trying to understand when is the time to buy, when is the bottom, and it's impossible to perfectly time a bottom of any cycle. But this survey from CBRE, and they talked to 200 professionals who have really good insight into the market. They're expecting that we're kind of at the bottom when it comes to this cycle.
Interesting. Okay. Yeah, you and I have talked about the clock effect, and you can never really know when you're at that 6 all the way at the bottom. But even just trying to time it in the 7, the 8, whatever, kind of get around there. But it's interesting that they're kind of pointing to this might be the actual bottom. So
and I'll just talk to that just a little bit because that's a great visual. So when you're trying to time the market, it's impossible to do it perfectly, but one veteran on Wall Street explained it to me this way: is if you have an old analog clock and the minute hand is at 6, that's like the bottom of the market, and then if it's at 12, it's at the top of the market. And he said you can't buy right at the 6, but if you can buy around the 7, coming up, so it's gone through the downsides, coming up, you're going to do great as an investor. And it's impossible to sell at the 12, but if you can sell at the 10 and a half or 11, you're going to do really well. So that's what we're starting to feel, is we're starting to be on the upswing of that cycle. And when a lot of people in an industry are starting to see it that way, that also matters because there is an impact to how other buyers and other sellers are thinking. And we still have to see if that interest rate cycle comes through. But many people are believing that that's coming up.
People are optimistic for that. So we did touch on those interest rates, but the article also talks a little bit about trade policy and tariffs and the effects. Do you want to talk about that a little bit?
Yeah, I think that's some of the uncertainty in what happens with interest rates. So the Fed has a dual mandate, which means they have to keep two things in check in any decision that they're making. The first mandate is to keep prices stable, which means they don't want inflation to go above 2% annually. And we've been over 2% for several years now, but it's come down from, the peak was 8 or 9% now to more 2.5% to 3% right now. But that's the other thing they have to keep in check. And then the other thing their other part of their dual mandate is full employment. So they don't really have a mandate to ensure that the economy is strong, or that the stock market's going up, or that commercial real estate is doing well. They don't have that mandate. Their mandate is full employment and price stability. So that's the debate every time the Fed meets, is what's going to happen with prices and the tariffs. We're not quite sure if we're going to see some increase in inflation, a significant increase in inflation because of the tariffs. Most people think we will see a little slight uptick. But if it's a one-time bump and then we can get back to normal prices, then it gives the Fed the ability to say, okay, prices are stable, let's go ahead and keep interest rates low. If they keep interest rates low, then that is to support the economy and to support full employment. So that's where if they start seeing weakness in job creation, then they want to bring interest rates down so that the economy stays robust, so that they meet that second part of their mandate.
Do you think that investors should be celebrating this cap rate stabilization right now, or do you think people should still be wary? I mean, you kind of talked about this a little bit, but do you think this is our moment, it's about to turn, like with that cycle, or where do you fall on the line?
I think it's really good to see this data, And if you're an investor, you need to be paying attention to what is happening right now, because a lot of investors are on the sidelines. They're wanting to wait until things really get figured out and there's more assurance that we're going into a lower rate cycle. But I think right now is where there's opportunities. If you can be a bit forward thinking, we're always looking at where the puck is going, not where it is today.
Yeah.
So no, I think this data matters a lot. And if you're an investor who's paying attention, now is a great time to go buy assets before we get into that rate cycle where rates come down consistently. Because when that happens, that's when things go from a buyer's market to a seller's market. If rates come down significantly over the next year or two, then you'll want to have bought assets today.
Right. You will no longer be at that 6, 7, 8. It will be climbing up to that 12.
You've kind of passed.
Yep, you missed it. You missed it a little bit.
That. And so we're in the early stages right now. We're buyers if we can buy good real estate at discounts, because we know we can buy distressed assets today. Then we're buying as much of that as we can, as long as it meets our criteria, because we can get great deals on it.
Yeah. And you guys are a great example of that, because even just with the most recent Neighborhood Ventures, we won't get too much into this, but it's such a discounted deal, this distressed asset that you could just got for the opportunistic fund. It's pretty incredible. So
it's about 40% discount from what they bought it at.
That's great.
2.5 years ago.
Yeah.
And this isn't in a part of town that you don't want to own buildings in. There's parts of towns that are part of Phoenix Metro that are struggling right now. This is not in one of those areas. Right. This is in the Central Corridor.
It is
highly desirable area. The property needs to be renovated. That doesn't scare us at all. But if you can buy well-located real estate today, like that asset, it's a great time to get it on a discount.
Definitely. Yeah, I think what you guys are doing is really cool, and like you said, very forward-thinking and just very inspired. So let's move on to the next article. The title here is Apartment Transactions Rise 12% in Q2 as 1,500, a little over 1,500 properties change hands. So, okay, more transactions are happening. Does this, in your mind, equal a rebound, or is this like a temporary bump up?
Yeah, we're starting to see the early signs of, they call it the canary in the coal mine. You start to see some things happen that are positive. So transactions have been way down for about 2 years now, because buyers have said, we're going to wait this out. We're going to wait this higher interest rate cycle out. We're going to wait to see if all these new apartments that were built get absorbed. And in Q2, we saw a 12% rise, 14% year over year. So the trend is certainly moving in the positive direction. And we're starting to see that as well. We're starting to see more transaction volume, more buyers come back into the market who have been on the sidelines. And a lot of this has to do with where you're getting your capital. So if you have dry powder, or if you already have capital that you've raised that's sitting there, there's a need and a desire to start putting it into new deals. And then there's also a lot of groups where they need to go out to their investor pool and raise capital on a specific project, a specific deal. And if you have the confidence that you can go raise that capital, then you need that confidence in order to get a deal in escrow and to move forward with it. So we're starting to see that confidence come back.
Yeah.
So that people start moving forward with some of these projects that they've been on the sidelines with.
Yeah, well, it's exciting to see. It's exciting for kind of everybody in this industry to see that kind of movement. But it does say in the article, the average price per unit was about $2,014, compared with per unit pricing averaging $151,000 from 2015 to 2019, meaning that it has gone up significantly in just a couple of years here. I mean, do you think that multifamily is getting overvalued? Do you think we're getting to a point where it's becoming overpriced?
If you look at the period that they're looking at from 2015 to 2019, value of real estate has gone up quite a bit in that period. And apartment values have gone up, but they haven't gone up as much as single family homes have gone up in value.
Yeah, that's true.
So if you think of the substitute for renting or the alternative to renting, it's buying a home.
Yeah.
And we are still well under the cost to buy a home if somebody chooses to rent is still significantly less than if they choose to buy.
Yeah.
Now, there's a lot of debate right now that if interest rates come down, what will happen with the single-family home market? And some folks think that the prices will come down on the homes. Some people think they'll stay the same. Some people think they'll go up. So we'll see. But the cost of renting is about 50% cheaper today than it is to buy a home.
Yeah.
And that is lower than it has been for 38 years.
Yeah.
So until that changes, there's a lot of room for rents to continue to move up. Typically, it's about the same cost that if you're going to rent versus buy, it should be about the same on a monthly basis.
Yeah.
But right now, there's a gap. It's much more affordable to rent. So we have a lot of room to grow.
What do you think will be the main catalysts? Because I know there are a lot of things that are keeping rents kind of stabilized right now. What do you think, other than single family homes and interest rates changing, what do you think is a catalyst for multifamily rents to start going up?
The big one is supply and demand.
Okay.
So we have had a lot of new supply, a ton of new supply across the country. And in our primary market, Phoenix, we've had now 3 years, we've been number one or number two for new apartments that have been delivered from ground up construction.
You could drive anywhere in the valley and see new apartment buildings go up for the last 5 years.
Yeah.
And now it's kind of stilled a little bit.
And that's part of a cyclical industry. There's a lot of excitement around what multifamily means and why we need it because the cost of homes have gone up. So there tends to be too much exuberance and overbuild.
Yeah.
And that happened. So we had 3 years of about 20,000 new apartment units for 3 years in a row here.
Yeah.
And what we're seeing in the data is that those apartments are getting absorbed. So people are moving in, but that's because we're in a high growth area. Phoenix's population is growing, employment's growing, wages are going up. And then what you also see is there's a lot of exuberance in the building side. But now as we look at the forecast for the next 3 and 4 years, the new apartments that are being delivered from construction, it falls off a cliff. So we're going to go to an undersupply. That's when rents move up. So that's, for an apartment owner, that's kind of a good thing when there isn't enough supply.
Yes.
Because that's when you'll see rents move up. Because we haven't had rents go up for 3 years now.
Yeah.
So that's what will drive it. That's what we track. And we're in that cycle now as we're kind of in the inflection point where the remaining new buildings that are coming up, and we'll see, there's one near my home that just got completed and now they're in lease up mode, but people are not building new buildings. In fact, right behind us here, this was supposed to be a big new luxury apartment complex that they backed out of, and now it's sitting as dirt.
Oh, wow.
Because the numbers didn't make sense anymore. And there's a lot of that around town. Now that'll probably sit there for 4 or 5 years. Someone else will come and buy it on the next construction boom cycle and build. That will happen eventually. But right now, it does not make sense to build stuff today because the cost is so high. It makes more sense to buy. So we're an investment firm. Instead of building, we're going and buying properties that are well below replacement cost. And that's what makes the most sense from an investment standpoint.
So you're buying it, even though it does need some renovation, that's still more affordable, obviously, than building from the ground up. So you're saying, let's find these distressed assets, let's put some money into them, and we're still going to turn around with a better profit margin in the end. Yeah,
and we're way under the replacement cost of if we were to build that brand new. And we're also buying some distressed properties that don't need any renovations. They've already been renovated.
It's even better.
And so that is our strategy today because we can go buy those so far below replacement cost, and that will change. So we have to continue to see what is the cost to build, and we'll look at some point, maybe we'll be the one who buys this land and builds.
Yeah.
But we're in a cycle right now. It makes a lot more sense to go buy than to build.
Gotcha.